in 2017, I met Joe Fairless, the author of your red book behind you, and he introduced me to apartment syndication. And I'm like, I could buy real estate with other people's money. And how cool is that? And I can increase my net worth, increase my cash flow and everything, and still do that. So we joined the mentorship program, learned about apartment syndication. And then from my standpoint, since I'm an engineer, I create systems in Excel. I did that for 15 years as an R&D engineer. I started creating an underwriting model so that I can start understanding the numbers of an apartment complex.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder, and CEO of Zana Investments, Tim Little. And on today's show, we have with us Jason Williams. Jason is the founder of the Ironclad Underwriting Mastery Program, co-founder of the Academy Presents, and managing partner of Lauren Capital. With degrees in chemical engineering and a 15-year engineering career, Jason combines analytical precision with real estate acumen, making him a trusted authority in the field. Jason, welcome to the show.
Thanks, Tim.
It is great to have you. So I am excited to learn, of course, more about everything from Ironclad Underwriting to Lauren Capital. But first, please tell us how you got started in real estate and how you got to where you are today.
Yeah, so I grew up with real estate. My parents were investing in real estate. I had to go help mow lawns at my parents' houses and apartments, and I hated every minute of it. But I did see the benefits it gave them and also learn something critical that you should not self manage and do the work yourself. You can get people to do it for you. And so, right off the bat, I knew I was going to invest in real estate and I knew I was going to hire a manager to do it. My wife also grew up in real estate. Her grandparents had lots of houses. They got into it in like the late 70s, early 80s when interest rates were in the double digits and they were still able to make everything work for them. So she grew up with that. She saw how they would go to each door knocking for rent every month. And she's, nope, I like the real estate, not going to manage it. So right off the bat, we were in agreement with what we wanted and how we were going to do it. So really, that's when we got started. I bought my first house when I was in grad school in Lubbock, Texas, when I was going to Texas Tech. And we knew we were going to rent it whenever I graduated. And so that's really when our real estate journey began. And so when I graduated, we moved away. We still have that house and it's still occupied. It's still paying rent. We've or cash out refied it a few times already. We've been able to get more houses where I currently am, but every time we had to save up enough cash for a down payment in the single family. So it took 3, 4, 5 years before we built up equity to refi or build up enough so we could buy a new one. And then in 2017, I met Joe Fairless, the author of your red book behind you, and he introduced me to apartment syndication. And I'm like, I could buy real estate with other people's money. And how cool is that? And I can increase my net worth, increase my cash flow and everything, and still do that. So we joined the mentorship program, learned about apartment syndication. And then from my standpoint, since I'm an engineer, I create systems in Excel. I did that for 15 years as an R&D engineer. I started creating an underwriting model so that I can start understanding the numbers of an apartment complex. I've had many different models throughout the 7 years that we've been doing this, and I never found any that I liked. So I started creating my own. I started grabbing everybody's model I could find and taking the good parts of it and putting it into mine, getting rid of all the bad parts. And so mine is constantly evolving. Now, with interest rates the way they are, you get a lot of creative financing, and there's a lot of models out there that can't allow for that. So since I wrote mine, I was able to put in creative financing options into my model so that I can underwrite realistically and be able to do like maybe seller carryback at a certain percentage and maybe a mezz debt or something. There's all sorts of options now that previously you wouldn't even really consider. And so that's really where I am now with my whole real estate journey. It all started with a
Oh,
single family home, and now I'm into multifamily, and I like multifamily now.
that's awesome, and it's not uncommon to start with that single family, but it sounds like you guys are essentially a real estate dynasty, having been raised with people who were doing it before you. I think it definitely gives you a leg up. You may have said, like you said, you hated it, but that's because you were probably doing the worst jobs associated at the time. But at the same time, you were learning a lot, it sounds like, from just the exposure, right? Seeing it,
Yep.
being there, understanding what the benefits were and why they were doing it, and
Mhm.
understanding that it was even an option.
Yeah, for sure. And yeah, I was doing the worst jobs. I was having to cut grass where the grass was 2 feet tall, and I had just a single push mower on an acre and a half lot. Yeah, that's like the worst thing you can even try to do. But my dad was trying to save money because he'd buy a new property and then he wouldn't have enough to like do a whole lot to it other than what we would do, like our sweat equity. And so he used my sweat equity more than he did quite a bit, but then eventually he was able to get out of it altogether and let his managers run everything.
Yeah, and you hit on a pain point that I hear from a lot of single family investors, and myself included when I had small multifamilies that I tried to self-manage. I think you learn a lot while doing it. That very ground level, what it takes to manage a property, which is important to understand for context, right?
Mhm.
If you want to manage the manager and understand how those property managers should be effectively running your properties, I think it's always helpful if you've had that experience yourself dealing with tenants directly, dealing with the repairs and the costs associated. So it's not a negative, but certainly something you don't want to you want to do forever. And I think a lot of us realize that, whether it's some breaking point or just a accumulation of little things over time, or no, I'm done with this. It isn't worth the 10% or 7% or whatever it is that you do have to pay in terms of the value of your own time. And every person has to decide what the value of their time is, I think.
Yeah, and when I was in my engineering job, but there were a lot of people, a lot that would buy a house, they would self-manage it, and I would tell them what I do, and they refuse. It's like 10% is too much for them to pay someone else to manage it. And so they would end up getting burnt out, and now they don't even invest in real estate. So they don't even doing it anymore because they got burnt out whenever they tried to do everything on their own. Now, I also know people who have 60 to 100 units, single families who self-manage and are quite content. So I think it takes a special kind of person to be a property manager, and I need those people, but I'm not one of them.
And sure, it's certainly possible, but you have to be a master of systems and time management and everything else in order to make it happen at that scale. And I give anyone who can do that massive kudos. But I personally, having done it for just, like I said, a small triplex, I was like, nope. After a year or two, I was done. Just the random calls for this, that, and the other. Oh, I have a bee infestation in my bedroom. Like, what? What? Like, just the weird things that come up that are real stories. One tenant doesn't like the other tenant, and they're calling me to arbitrate. I'm like, you guys are adults. So it's just a lot to
Yeah.
deal with, and a lot of it comes down to not only property issues but people issues.
Yeah, and
But
it's like you call me whenever there's a big old plumbing issue and I have to reroute a sewage line underneath the house. Let me know then. If it's not that big, I don't even want to know about it. And this might sound crass, but I don't want to know really who my residents are other than like their name and if they pay on time or if they have any extenuating circumstances, but they're normally okay, I'll help them out, but I don't want to get involved in their personal life. I don't want to know if their dog died and their grandmother's in the hospital or anything like that. I'm sorry. I'm maybe I'm too impersonal like that, but
no, I get it. And so you talked about how you were relatively successful with that. If you were able to refi a couple of times, but again, another pain point that you brought up that, again, I hear with a lot of the single family side of things is the saving up enough capital to put down for that down payment, right?
Mhm.
Most banks, lenders require 25% down payment for an investment property, especially if it's in that single family range, 1 through 4 units. And 25% can be a lot when you're talking about the cost of properties nowadays. So it's not for me when I bought my first property and I had to save up like it was like $25,000. And I was like, oh man, this is a lot of money. And at the
Yeah.
time, it was a lot of money for me to save up. Imagine a property twice as expensive. Now you're talking 50,000, so on and so forth. And so you're right, just the time in between that it takes to save up that capital, especially if that the properties that you have are only kicking off $100, $200 a month in cash flow. Hopefully, God forbid you have something break and then all of a sudden that cash flow just disappeared in the blink of an eye. But that was my experience, and so I definitely resonate with that pain point as well.
Yeah, that's exactly what it was. We were lucky if we were able to do it that way. And if you go through like the conventional mortgage route, I got a loan from my parents for a down payment because I got a house that I really want to get. And so they wired $25,000 to me, and I was going to use that to as a down payment. Now all of a sudden the bank wants to see their financial records, or it has to sit in my bank account for 60 days before, and they call it seasoning, before
Yeah.
I could even use it. It's the hoops they make you go through are crazy. So then I discovered I can buy single families through my commercial lender. Yeah, my interest rates might be a little higher, but the timing I can close within a whole lot less time. I can put money in my account from my parents loaning me or whatever and not have to season it or anything like that. And they do desktop valuations of everything, so I don't have to pay for a full appraisal. When I discovered that, I'm not going to do another one. The ease of it is there.
Yeah, I don't
And
blame you.
the last time I bought a single family, this is right when I was starting to get into multifamily, but still in the single family realm. We were able to buy a portfolio. We refied, cash out refied another property, and we walked away from closing with $18,000. When I was there, they're like, "All right, you owe us 18,000." I'm like, "No, you owe me 18,000." And the title company is, "No, that's not how this works." And then they had a senior person there who says, "Oh yeah, we do owe you 18,000. You'll be getting a check in the mail." You expect me to come with a check, but you don't provide me a check whenever I'm closing out. How does that work? And yeah, that we got 18,000 in the mail eventually, but it was pretty cool that we didn't have to go out of pocket for that last closing. And we got some additional capital that we could deploy elsewhere.
Yeah, that's always awesome when you can get money at the table. So talk to me about that transition to the syndication, the commercial multifamily side of things. How did you start out? Did you start out as a limited partner to get your feet wet, or did you jump right in, start doing syndications?
2019, something like that. We joined one program and we floundered in it. They were like wholesaling apartments, but the guy who's doing it taught our mentor, and our mentor was very successful. So I figured if we create him, we can do the same for us. But no, we floundered in it for about a year and a half. So then we joined our mentor. Haven't looked back. We did not buy our first property until 2021 as a syndication. So I did invest as an LP in some just so I could see what to expect as an LP so I can treat my investors the same way. So I get the
Mhm.
reports they want, get all the communication they need, get set up the platforms, the portals, stuff like that, just so I could see what they're doing and how do I mimic it. And the thing with this industry is, yeah, people think it's competition, but I don't think it's competition. It's like I invest in my market, you invest in your market. If those two intersect, guess what? We can work together and buy a bigger property working together. There's really no direct competition per se. So I don't see it as a bad thing to work with other investors in that regard. But then we had a broker sent my wife a text. or one of the texting platforms saying, "Hey, this property in your area is for sale." And so we got a tour of it. And this was in 2021, summer 2021. So you have to have hard money down. You have to so competition is high. A lot of people are going to be bidding on it. So you have to pull out all the stops to try and win it over. And we ended up getting it, and that was 3 years into our mentorship program. So what we ended up doing was, our mentors like, you need to create a thought leadership platform. So my wife has a podcast. She has the Academy Presents Thought Leaderships, and she's doing all this stuff that's putting our name out there. We didn't even have a deal yet, and we were getting in, learning, meeting all these big people in the industry, getting her on the podcast and everything else. Again, we hadn't had a deal yet. And then when we did get our first deal, she was able to raise $1 million right off the bat. Like, no, never raised before or anything. It was for our own deal, and raised $1 million. So thought that was a fluke. Next year, we bought our second property. We're averaging about one property a year. I want to increase it, but that's what we're doing. And then again, raised over $1 million. The way our mentor taught us is working. It's slow from the beginning, but it is working. And that's where we are now. We have two big complexes that we did syndications in. I'm in maybe 10 vacations or so as LPs. I left my W-2 job in July of 22. So I had my 401k. I rolled it over into a self-directed 401k, and then I just started investing in other people's deals, and then they'd invest in my deals. There's a lot of reciprocation going on that way. So I feel more comfortable pulling it out of the market and putting it into real estate than, because I wasn't going to manage it. I'll let the real estate take care of itself. Generally speaking, real estate's a good market to invest in.
Yeah. Okay. You covered a lot of ground there. And a couple of points that I want to reiterate that you brought up. You said you took your time right before you got that first property. And I think that's important, but I think the results speak for themselves. If you guys were able to raise $1 million on your first raise, that's amazing and not something that I see very often. So clearly, you guys put in the groundwork in order to get your name out there and your reputation. And I think a lot of people who are looking at this business, syndication specifically, and they're thinking about doing that themselves, they wonder, how do they get legitimacy without having that first deal? And so they start to think of it as this chicken or egg kind of situation, like, who would invest with me if I've never done a deal before? But then they hear a story like yours, and I'm sure they're just like, how did they do that? So, how did you do that? How did you get over that that argument, that fear that investors might have with you not having done a deal before?
So it's all about that thought leadership platform. A lot of it is outlined in that best ever book right above your head. Almost follow it to the T. I've actually known people who have followed it to the T because they couldn't afford a mentorship program, and they were successful so long as you go through the steps. But yeah, just get your face out there, even with you. So you have a podcast. Now you're the expert. You might not know anything, but you bring on experts. And so that positions you to be an expert as well. So people are going to be looking up to you. If they listen to you a lot, it feels like they already know you before you even know who they are. And so that is one of the biggest things that we've learned is put yourself out there, let people see you. Yeah, you're not going to resonate with everybody, but you are going to resonate with a bunch. And yeah, if you tell your story, people want to listen. And also lets people know that they're not alone. So my story is different from his. Is if you listen to him, I mean, you might actually have pretty common stories or know somebody who does. So that helps resonate with people. And then when you can resonate with people, then you start to begin to like them and trust them. And you have to that whole know and trust funnel thing. So get yourself out there and get people to know you and resonate with you, and then everything else will follow.
Yeah, and I'm sure your wife Angel could attest to this. And one of the advantages of doing a podcast is not only do I get to have smart people like you on the show and be seen with experts, But at the same time, I'm always learning things too, right? Because
Mhm.
I'm getting people from different aspects of real estate, whether it's the lawyers, the CPAs, the passive investors, or the syndicators. They're coming at it with different perspectives. They're bringing different knowledge to the table, and I get to siphon off some of that knowledge myself as I'm sharing it with the people who are listening. Yeah, it's a huge benefit from that respect. One of the other things that I wanted to talk about, you talked about a lot about your underwriting model, and I think you're in a better position than most as an engineer, right? Understanding numbers to build that out. And you did what I've heard other people have done. They basically take everything they can get and then find the things that they like about some models, but look for those gaps. What information isn't this giving me? Or what is this not able to calculate? And it sounds like you made a model that works for you for the information that you were looking for, but it's also dynamic, right? It's able to adjust to changing conditions in the market and do those calculations as well, which obviously makes it very useful for you when you're doing your underwriting.
Yeah, so having the benefit of creating my own model, I pretty much know what every cell does or is supposed to do. So I can go in and change my formulas so that it is dynamic. It does change with the market and the environment. It also changes with the asset class. I've tailored my model, which is started out as for multifamily. I've tailored it for mobile home communities, self storage, working on getting a hotel version. But I've
Mm.
also created a RV park. I can create all of those, and like the main engine of my model is the same. So I don't have to keep reinventing the wheel each time. It's just how do the inputs come in differently in the income streams, but for the most part, a lot of it is the same. I'm also doing it for like ground up construction where you're not going to have a T12 and a rent roll to go off of because there's no property there yet. So how do you do that? Because if you just go off of somebody multifamily models, like you're not going to ever find a deal because you can't get the numbers you need or whatever. And it's hard. So you have to have like specific models or a model that can adapt to whatever you're investing in. That's what I've created.
Yeah, and that makes sense. And so I guess I'm wondering, because the market has changed a lot in the past, say, year and a half. What of your underwriting assumptions have changed during that time, whether it's rent escalation or cap rates or anything else, really? What of your assumptions have changed in the past, say, year?
My assumptions when the market was doing really well, I still used lower assumptions like 3% rent growth per year, sometimes four,
Mhm.
depending on the market. When I'd help people with their underwriting, I mean, it could be, I generally try to keep it like three or four. If there's something that goes above that, I would at least flag it so that you would know. But lately now I'm in my own deals, I'm doing 0% for year one and one in year two, and then slowly tapering it up to say three or four
Mhm.
back to where we were a few years ago. So that is one thing that I've been doing on my own deals because I know my market versus when I help somebody, I at least let them know, hey, this is what's going on. You might want to do some research. But as far as the model's concerned, this is what I'm doing and the assumptions I'm making. Because you always hear people say that their underwriting is conservative, but in all honesty, there's no conservative underwriting. Either you're competitive or you're not going to get any deals. And unless you like the seller or you get it in somewhere where they're not going to even put it on the market or not look at other people's deals, then your conservative numbers are not going to win deals. And that's just the truth of it. There is some certainty of close. If they know you're going to close, then the seller might go at a lower purchase price or something than somebody who offered them like 5 million more than what they're asking for. But really, it's all about risk tolerance for you and for your investors. And so that when I always think it's funny when people say conservative, and I sometimes say conservative just because that's what people expect to hear, but it's all about risk tolerance.
Yeah, and that's I think what a lot of investors want to hear because they feel like the risk is lower if you say that it's conservative. But if you're going to say that, then you have to show them, well, what
Yep.
about your assumptions, your numbers are conservative. Okay, whereas one guy may be assuming this cap rate, I'm assuming this cap rate, so that they at least understand what about it is conservative instead of like you're saying, just using it as a buzzword because it often is, right? So I think that education piece is a huge part of what we do when we're explaining things to investors, not just using the right language, but explaining the why behind it. The other thing that I wanted to just highlight because you threw it out there, and I know a lot of people may not be familiar with it, is you said you rolled over your 401k into a
Mhm.
self-directed IRA. First of all,
Yep.
congratulations on getting out of your job and rolling that over. But I want people to understand what that actually means. 401k, most people are pretty familiar with that, right?
Mm.
Don't have a
Yep.
whole lot of control over what it's invested in, etc. A couple of funds maybe you can choose from. But once you put it into that self directed IRA, then you have a lot more flexibility in terms of what you can invest it in. And just one example of that is real estate. If you want to put it in crypto or whatever, I don't recommend it. You're more than welcome to. But deals like this, real estate is one option. And that's something I've done as well with one of those orphaned 401ks that I had from a previous job, right? It was just sitting there. I wasn't even contributing to it anymore and it wasn't really doing much. It wasn't hurting me, but I was like, why don't I get control of that money? And so I was
Yeah.
able to do that. And I did the same thing you did, right? I put it into a syndication so that I could see it grow faster and with something that I had much more confidence and understanding in than, say, the stock market.
Yes, there are self-directed IRAs, and I have mine in a self-directed 401k. The main difference is I don't have to go through a custodian to get my own money to invest it. I basically have my own checkbook and I write it to a syndication. But one thing about syndications and retirements is legally speaking, you're not allowed to invest in your own deals. You have to be like an arm's distance apart from it. So I can't control any of it when it comes to syndication. When it comes to buying single family houses, I think I can do it that way. I don't know all the nuances or the laws regarding that. And I've talked with a lot of people from Quest and some other self directed 401k companies, and they say for like single families, you can. It doesn't have to be an arm's distance, but for syndication, which is more or less an SEC security, and I think that's why it has to be an arm's distance. That so whenever I invest in somebody else's deal, there's like reciprocation going on. They can invest in mine with their 401k. I can invest with them with mine, and so it helps everybody. And the way I see it is rising tide raises all ships. So if I can help you and you can help me, then we're both better off. And
Yep. And
again, I don't want to have to manage stocks or mutual funds or anything like that because that could be another day job just doing that by itself. So
yeah, and I don't need that kind of stress. I'm happy to get a investor update once a month, see what my money is doing, make sure that deal is going okay, asking any questions that I want to ask about that deal. There's just a different level of freedom and control, I feel. And I'm like you, I have a solo 401k. And there are distinctions between self-directed IRAs and solo 401ks. I don't want to go down that rabbit hole because it can get very nuanced. And none of this is tax advice, by the way.
yeah, I'm
Case.
not a tax advisor, not a lawyer, not an accountant. I'm just a guy who's doing it and somehow making it work.
Yep, exactly. All right, so we do have to transition to the turbo round now. So I'm going to ask you three questions that I ask every guest that's on the show, and I just ask for a quick, honest answer. Are you ready to go?
Yes.
All right, let's do it, Jason. So, first one, what is one red flag every investor should look out for?
Every investor should. So I always get this: what's the riskiest investment? The investment for me is one that I know nothing about. So if you want to invest in stocks, you better know about those stocks. If you want to invest in real estate, learn about real estate. If you want to invest in a syndication, learn about real estate. Learn about the operators who you're investing with. If you want to invest in oil and gas, learn about oil and gas. So one red flag is investing blindly and not knowing what's going to happen and hoping for the best. So I know a lot of people who do that, and there's better strategies than that.
Agreed. My philosophy is I try to learn enough about the asset to ask intelligent questions. Because if I can't even ask the right questions, then I probably don't know enough to be investing in it.
Yep.
All right. Next one. What is a myth about this business that you would like to set straight?
We have a running gag in one of our property meetings that we meet every week. It's like, oh, you're going to get rich in real estate. It's like, you can get rich in real estate. It also requires time and it requires sweat equity. And so it's not a get rich quick scheme. I think some people think it is and then realize it's not, and then get out and then chase another shiny object. But no, it is a long haul game. It is viable, but you have to put in the work and you have to do it, and you have to be consistent with it, and it will pay off. But not quick, not get rich quick. It's not going to happen overnight. If you see someone who got rich overnight, you haven't seen the last 10 years they put into it to build up to that.
Yeah, absolutely true. And I think a lot of people are learning over the past couple of years that it's not risk-free either. For a time, people thought like you couldn't lose in real estate, and it was impossible to lose money. And while in every PPM it says like all the risks associated, you could lose everything in this deal. For a time, it was like, yeah, you'll read the PPM, it'll say all the dangers involved. Just ignore that. It's just to scare you and let you know that it's possible, but it's not going to happen. And it's happening in some instances right now based on the last year or two.
Yeah, I know one operator who had lost over $100 million of investor money. Just went $100 million going to zero. That is scary, and that's eye-opening. And so no, it is not risk-free. There's plenty of risk, and that's why you have to do your research on the operator, because a few years ago everybody was going to make money, but nobody can predict the inflation we've been having and the interest rates going up and debt service doubling and tripling, and all of a sudden you can't make debt service because it went from $20,000 a month to $80,000 a month just for the paying the mortgage on it, and that happened, but just like that. So
yeah, it's crazy. All right, and last question: what does success look like to you?
I'm still working on that. Ideally, my success is I want time freedom, I want financial freedom, location freedom, and relationship freedom. I want to be able to hang out with who I want to hang out, where I want to hang out, and not have to worry about the money. So once I get all of those, I will probably not even think I'm been successful. I'm still working on it because I always want more, but it's like they say, success is a journey, it's not a destination.
Absolutely. All right. This has been awesome, Jason. I appreciate you coming on the show. Please tell our listeners how they can get a hold of you and if there's anything else you'd like to share with them.
So if you're interested in learning more about underwriting, and at the time of this recording, I am working on getting a lot of free resources up on my website, which is ironcladunderwriting.com, where you can go and you can download a lot of PDFs on the ins and outs of underwriting. You can go there, you can set up a time with me if you want to learn more. Hop on a Zoom call, we can discuss it. I have an underwriting course that you may or may not be interested in if you want to learn even more and expand your underwriting skills. This is not just for operators. I've taught LPs as well so that they can vet deals better, versus because if you don't know how to vet a deal, then how are you going to know if you're investing in something good? And all that goes back to do the research for your investment. You can also find me on LinkedIn. I think it's Jason Williams, PhD is my name on LinkedIn. And I'll get all the my links and everything over to you so that you can post them in your show notes and everything like that as well. So,
All right. Yeah, we'll definitely have all that information in the show notes. I appreciate you coming on, Jason, and I look forward to continuing to see you do big things on your journey to multifamily millions.